Hello everyone, welcome to this course of Metrics and Analytics of Marketing. In the last class, we discussed about the metrics of interest. The importance of metrics of interest was detailed in the context of emerging digitalization. In today's session, we will focus on understanding and measuring margins, which is a crucial part of marketing metrics and analytics. Basically, margins help us understand not just the profitability, but also the strategic health of a business. Managers rely on margins to make decisions on pricing, cost control and growth strategies. Let us now move to understand what this margin is all about. Basically, margins represent the portion of revenue that remains after certain costs are deducted. This cost basically include the cost of goods sold, the operating cost, administrative cost, overheads, tax and interest. When we look into margins, they are indicators of efficiency and long-term sustainability of a business. Unless and until there is a acceptable level of margin at each stage of the business calculation, the long term sustainability of the business is in question. A business with a strong margins has the flexibility to invest in research and development, they can invest in marketing, they can invest in innovation, they can invest in advanced technology, and they can also invest in human resources. In today's session, we will discuss about 4 categories of margins, namely the gross margin, operating margin, net margin and contribution margin. Except this contribution margin, all 3 other margins, gross margin, operating margin and net margin, they work like a waterfall model. One margin can be calculated after certain parameter deduction from the another one. For example, when we deduct the rent, the cost related to the rent, the cost related to some administrative cost from the gross margin, it becomes my operating margin. And when I deduct the interest and the taxes from my operating margin, this becomes my net margin. So, this works like a waterfall model. Then we will delve into each of these margins one by one. Let us first try to understand what is gross margin. Gross margin focuses on production or service delivery efficiency. It compares revenue with the cost of goods sold. Higher gross margins indicate better pricing power or cost efficiency. Gross margin includes the cost of material, the cost of labor and sometimes the factory overhead. So, this factory overhead might include the rent, utilities and depreciation of the production equipment. It also includes the freighting cost, which is the shipping cost incurred in bringing inventory to my facility. Gross margin does not take into consideration the cost incurred in rent, salaries, marketing or taxes. So, we can have this one, we can just look at this formula of gross margin. It is revenue minus cost of goods sold divided by revenue. So, basically most of the time gross margin is calculated in percentage. So, we multiply it by 100. So, let us have a look at one of the example. Let us say the total revenue collected by an organization in a specific time period is 1000 rupees. Now, let us also calculate the cost of goods sold, that is the cost of labor, cost of raw material and cost of factory overheads, that comes to 600 rupees. So, 1000 minus 600 divided by 1000, it gives me a value of 40%. So, how can I interpret these transactions? 40% of the sales is available to cover operating cost and profits. So, this is the basic formula of gross margin. Next, we will try to understand the concept of operating margin. Operating margin includes the operating expenses such as the expenses incurred in marketing, the salaries of the employees and administrative cost. Operating margins reflects the operational efficiency, which is the efficiency of a business management process. So, let us also look into one of the example of operating margin. So, if the operating profit is 200 rupees, in the previous example what was the cost of goods sold? It was 600 rupees. Now, we will subtract the cost incurred in marketing, cost incurred in administrative work and the salaries of the official staffs, those will be deducted. So, let us say those cost comes to 400 rupees. So, 600 minus 400, it gives us a operating profit of 200 rupees. Our total revenue is still that 1000 rupees. So, what is the operating margin? This is 20%. So, let us now look into this third concept, which is called the net profit margin. So, net profit margin accounts for all expenses including the interest and taxes. Basically, whenever we deduct or subtract this interest and taxes from the operating margin, this becomes our net margin. So, it represents the final profitability of a organization. Formula wise, net profit margin equal to net profit divided by revenue. It accounts for taxes, it accounts for interest and all expenses that can be related to the business operations and business taxation. Let us take an example. Let us derive the example from the previous examples only. So, what was our operating profit? That was 200 rupees. Now, let us say a portion of the operating profit has to be paid in terms of interest for the debt that we have taken for running our business and the tax applicable taxes. Let us say the summation of this interest and taxes comes to 80 rupees. So, operating profit which was 200 rupees minus this 80 rupees gives me a net profit of 120 rupees. Our total revenue was 1000 rupees. So, that is why the net profit margin will be 12%. So, this is a very simple calculation. There is no rocket science. I mean simple arithmetic, simple formula based understanding, but these metrics are important to keep a tab of, because unless and until we understand this matrix, we will not be able to realize whether our business is actually making profit or in the direction of making profit, or it is actually going in the direction of making losses. So, that is why this particular metrics are important. In a typical scenario, gross margin will be the highest value, followed by the operating margin, and finally the net margin will be the lowest, because as I said that each subsequent calculation subtract more expenses. Together these metrics provide a complete picture of a company's profitability, from the efficiency of making a product to the overall financial viability of the entire business. Now next let us move to slightly different topic, which is related to contribution margin. So, contribution margins are not a direct part of your income statement. All other three metrics, your gross margin, gross profit, operating profit and net profits are part of your income statement. Contribution margin basically focuses on variable cost and supports short term decisions such as pricing and break even analysis. The contribution margin focuses on the split between the fixed cost and the variable cost. In the break even analysis, contribution margin isolates the variable cost to determine how much each cell contributes to covering the company's fixed cost. Remember, we discussed about cost of goods sold in our gross margin calculation, but it does not bifurcate the fixed cost and variable cost. In case of contribution margin, we are bifurcating the fixed cost and variable cost. So, variable cost per unit production remains constant, but fixed cost per unit production varies and it decreases as we increase the number of units produced. Let us have a look at one of the example. Let us say sales of rupees 500 with a variable cost of 300. So, this will give us a contribution margin of 40%. 500 minus 300, which is 200, divided by 500, which is 40%. So, this is about the basic concept of gross margin, operating margin, net margin and ultimately the contribution margin. So, contribution margin reflects the break even analysis of the company. How many units needs to be sold in order to achieve at a situation of no profit, no loss. Now, we will look into some of the techniques for margin analysis. So, we will quickly discuss about these 4 techniques: trend analysis, then product wise and customer wise margin analysis, break even and contribution analysis and benchmarking against competitors. So, what is trend analysis? Basically, we will look into what is the trend of sales, what is the trend of different margins. So, remember that whenever we are calculating the margins, margins are functions of price and cost. So, basically how the macro marketing environment is influencing the price, how the macro technological environment is influencing the cost incurred in production. So, these trends will influence the overall margins that an organization can derive from a particular business. Then we can also calculate it product wise or customer wise. So, what is the margin for this particular product line? What will be the margin for this particular product portfolio? And we can also calculate the possible margins for, let us say, high net worth customers, low net worth customers. Then we can also do break even analysis. So, break even analysis is nothing but finding out the number of units to be sold in order to cover the variable as well as the fixed cost. So, we will have a look into this formulas at subsequent slides. Then benchmarking against the competitors. So, whenever we are deciding on the price, we also need to look into the pricing of the competitors. We also need to look into this, what is our value wedge, what is our unique selling proposition. So, depending on multiple factors, we have to price the product and the price of the product will determine what will be the profitability or margins of our product. Then let us have a look at the strategies to improve margin. Basically, margins can be improved through pricing optimization, through cost reduction, through efficiency improvement and through certain changes in our product mix. So, for example, let us say one product line is giving us more margin, another product line is giving us very meager profit. Then in that case, we can concentrate more on the product line which is giving us more financial value and probably we can plan for a exit from those product line which is giving us a very meager profit. When we talk about this price optimization, optimizing the pricing strategies, the price of a product is optimized in such a way that overall profitability of the product line is maximized. We know that price is an antecedent of demand and supply. The relationship between price and demand is captured in the law of demand. In economics, we have studied about law of demand and law of supply. The law of demand says that for normal products, an increase in price will result in decrease in overall demand. If the price increases, probably the customers will look for alternative, customers will look for substitutes. So, that is why for normal product there are exceptions in place, but excluding these exceptions, for a normal product, normally when the price of the product is increased, then quantity demanded for the product will decrease. The supply is in reverse relation. If the price of the product is increased, then in that case the industry becomes more lucrative. So, more and more player will be there in the industry and there will be more supply. So, if I put quantity on the y axis and price on the x axis, when we talk about this demand curve, it is a downward slope curve. lower price, high demand, higher price, low demand. So, I mean if on the y axis the quantity demanded is there and in the x axis the price is there, then in that case the slope will be in the downward direction. On the other hand, the supply curve has a upward slope. I mean if the price is lower, quantity supplied will be lesser, if the price is higher, quantity supplied will be higher. So, it will take a upward slope. So, therefore, if I draw these two lines, then there will be a point at which the demand curve will intersect with the supply curve, and this particular point at which the demand curve meets the supply curve is the optimum price point, and this in economics this is called the point of equilibrium. So, if you price your product above the point of equilibrium, then your margin will be more, but it will not be able to compensate for the loss that is incurred in quantity demanded. Similarly, if you price a product lower than at the point of equilibrium, in that case your quantity demanded will be higher, but the loss in contribution margin cannot be compensated with the increase in quantity demanded. So, we need to exactly find out the point of equilibrium. So, this is called optimization of pricing. So, overall when we optimize this pricing, what is our objective function? Our objective function is the profit maximization. What is profit? How can we calculate the profit? Price, unit price minus unit cost minus unit cost that is attributed to fixed cost as well as variable cost multiplied by quantity demanded. So, this is a objective function. What is our variables? Decision variables? The change in price. We can change the price in order to maximize this objective function, and there can be constraints. Constraint can be the range of the price. So, based on this we have to optimize, we can optimize the margin by optimizing the pricing strategies. So, I will just quickly show you how this price optimization can happen. So, let me draw this graph roughly. So, as I said, I have to put the quantity demanded in the y axis, quantity, and on the x axis I will have price. Now, as I said, if the price increases, then quantity demanded will be lesser. So, let us say at this level when price is P1, then quantity demanded is let us say Q1, this point, this is Q1, and let us say when the price is P2, quantity demanded is Q2, price is let us say P3, quantity demanded is again Q3. So, the curve, say this is not a linear curve, linear line, because it does not work like a algebra. It is somehow related to your psychological factors also. So, the curve looks like something like this in reality. And when we talk about this supply curve, if the price is P3, supply curve will look like this. So, there will be a point at which this particular point, let me put it as P, this particular point the demand curve will meet the supply curve, and that is the point of equilibrium or the optimum price. So, anything above this P, that is which is P3, if we price the product at P3, what will happen? We will have more contribution margin. For each of this sale we will earn more. However, we will lose a lot in terms of the demand, and the additional profit that we are bringing in terms of the contribution margin will not be able to compensate for the loss in demand. Similarly, if price is lower than this, then in that case we will have more quantity sold, but this additional sale in quantity will not compensate us for the loss in contribution margin. So, this is a simple illustration of how pricing can be optimized in order to improve the margins. Next, let us have a look at the factors influencing margins. Market competition and price sensitivity. If there is more competitors in the industry, then the margins will be reduced, because you will be under tremendous pressure to reduce the price of the product. So, that is why your margin will be compromised. Then let us say if the product is of high price sensitivity, what does high price sensitivity reflect? A small increase in price will decrease the quantity demanded to a higher extent. This is what is price sensitivity. If you are dealing with a product whose price sensitivity is higher, then in that case even a single increase in price, though it will slightly improve your contribution margin, but overall profitability will be compromised, because the quantity demanded will be decreasing to a higher extent. Then margins can also be influenced by cost structure and scale of operations. I mean, if we can somehow reduce the cost of production, if we can reduce the cost of operations, then in that case our margins will improve. So, some of the techniques that can be applied, some of the tools that can be applied to reduce the, let us say, cost of production is, instead of more labor we will apply more automation. So, our margin will be better. Margins can also be improved by extending the scale of operations. We can play around the concept called economies of scale. If we are producing more number of units, then even a smaller contribution margin will make our business financially viable for a longer period of time. Then margins can be influenced by brand strength and differentiation. We know that if we are a well known reputed brand, then in that case people will not mind paying a slightly higher price than those for the same quality than those brand which is not well known or which are not reputed. So, this is what is called a brand premium. We can derive a brand premium because of the brand rather than the quality. Then differentiation, if we can stand ourselves out in the competition, then also we can improve our profit margin. Then margins can also be influenced by regulatory and economic environment. Let us say there is a upper cap on the maximum price that you can take. So, that will make a compromise on your profit margin. It is also dependent on the economic environment. The price is a function of the affordability of the target customer. During the period of recession, many companies used to directly or indirectly reduce the price of product, because the economic environment is demanding that. Otherwise, you cannot survive in the market. Nobody is going to buy your product. So, now let us quickly have a look at one of this small cashless EdTech certification firm. This kind of this one example we have taken in one of our classes already. So, I will not go for detailed illustration. So, an EdTech firm sells a professional certification for rupees 30,000. Now, variable cost per learner is 18,000. So, variable cost may be in the form of, let us say, the study material that needs to be procured for each of these participant, or let us say the platform charges that needs to be paid for each of the student. So, combining all this cost, it is, let us say, 18,000 rupees, and let us say fixed monthly cost is coming at 6 lakhs rupees. So, monthly cost can be in the form of this one, the cost of rent of the office, the cost of salaries of the staffs, So, these are fixed monthly cost, and let us say the monthly enrollment is 100 learners. So, in a month what will happen? What will happen to our finances? The total revenue will be 100 into 30,000, that is 30 lakhs. Total variable cost will be 100 into 18,000, that is 18 lakhs. So, overall contribution that is left for us is 12 lakhs. Out of this 12 lakhs, we have to pay this fixed cost, that is 6 lakhs. So, overall profit left to us will be 6 lakhs. So, what are the managerial insights that we can derive from this case or from this numbers? High contribution margins allows scalability. Basically, if the contribution margin is high, then in that case it will take lesser time and lesser effort to meet the fixed cost. In this case, what was the contribution per candidate? It was 30,000 minus 18,000, that is 12,000, and fixed cost is 6 lakhs rupees. So, 6 lakhs divided by 12,000, if we can enroll this many number of students, we are meeting the break even point. Anything beyond that, we are earning incremental profit. Small changes in enrollment significantly impact the profit, because the fixed cost attribution for each of this additional enrollment gets reduced as the number of enrollment increases. Margin analysis supports pricing and cost decision. So, what should be the price? So, we must have an understanding like what is the minimum number of enrollment that will happen without much marketing effort, and what is the maximum number of enrollment that will happen even after extensive marketing initiatives. So, within these 2 points we have to find out the optimum point, and that is how we can improve the margins for our organization. So, what are the key takeaways of today's session? Margins are central to evaluating business performance. Different margins serve different managerial purposes. Then real world cases help translate the matrix into strategy. So, this is all about for today. I will see you in the next class with some profitability metrics. Thank you.